Negative rates, are they the new norm in Europe? Corporate bonds, sovereign bonds? What is next? We're joined by William De Wilde, the Chief Economist of BNP Paribas. Hello.
Hello.
William, could you explain us what happened in the recent weeks regarding these negative rates?
Yeah, we've seen an amazing evolution since the start of this year. If you look at where interest rates were at the start of the year, and you can look at the chart, you have the interest rate structure within the eurozone. You have different countries and you have the structure of interest rates with short rates, of course, being below the long-term bond yields. When you look at it dynamically, what you observe is that interest rates have come down significantly across the curve and across countries. But you also see that they have come down to such an extent that for certain parts of the curve they have become negative, which is shown by the red bars.
How do you explain this evolution?
There are different factors which are behind this evolution. One element is that economic growth has been subdued. Admittedly, there is some improvement, but nevertheless, in level terms, growth is still pretty low. Another reason is that inflation has been very low and has even been negative because of the declining oil prices. And what we've also observed is that inflation expectations have come down.
What is the outview on the short term then?
Well, it very much depends on what the economic agents are going to do. That means, for instance, if you look at savings behavior versus investments, what you observe is that there is a kind of excess savings. That is because people feel uncertain, even corporates have a high degree of uncertainty, so they save the money rather than investing it. This is exerting a downward pressure on interest rates. What you also see is that bond markets have benefited from the fact that the borrowing requirements of governments have come down because of the past budgetary efforts, but also because the economy is doing a bit better.
What about the European Central Bank and the quantitative easing?
And then on top of that you have somebody else coming on the front of the scene, who is the ECB, who has then committed to buy 60 billion per month until September 2016. You put all this together and it means that rates still have to come down.
What are the consequences for the economic actors?
Well, it depends on which side of the table you are. So if you have projects that need funding, then of course it is fantastic. You will benefit from lower borrowing rates to get a credit from your bank. What is also great, of course, is that it is making the finance ministries in different European countries happy because of cheaper borrowing rates.
But the households,
that's another story, because they sit on the other side of the table, they come with the money, so they look for attractive investment opportunities and they're getting scarcer and scarcer. What it means is that you have very low nominal bond yields, and it becomes a real issue for households. To illustrate the point, the European Central Bank is saying to the European citizens, we are aiming for an inflation rate below but close to 2%. Fine, if you buy into that and then you look around, where can I find a bond to protect me against that prospect, you observe that you cannot find any bonds anymore that offer these types of yields. So you cannot really protect you against expected inflation. And then another phenomenon which is very important is that the accumulation of wealth by reinvesting your interest income slows down very significantly as well.
Last question, William De Wilde. What is your take regarding the evolution of these negative rates? Are they going to stay negative or they come back to the positive side?
Well, if you look at the economic outlook, and you have to look both at the US and at Europe, the shape of things to come is that in the short run you have the impact of QE and so on. We have discussed that. However, in the medium term you have the influence coming from the US, monetary policy tightening, pushing up US bond yields. And in a later stage you will have the confirmation of the recovery in the eurozone, which would also push up bond yields. So eventually yields indeed will move up, but it will be a very patient path that we have to follow to get there.
Thank you very much, William De Wilde. Next, we talk about Egypt with Pascal Devaux. This is the chart of the month.